everyone. Welcome to Retire with Style. I'm Alex, and I'm here with my trusted companion, Wade Pfau. And today we have a very special guest, Brett Leyton, who's also a member of our Retirement Researcher Academy. And Wade, you want to talk about a little bit what Brett brings to the table and what we'll be discussing today?
Absolutely. And Brett, I'll let you introduce yourself. But Brett's a CPA, and really the reason we wanted to bring Brett on for an episode is to discuss the new provisions in the One Big Beautiful Bill Act. There's a lot of new tax considerations. And when it comes to tax planning, we're getting to the point of the year where it's important to be thinking about that. So we really wanted an expert who could help us walk through all the different provisions of the One Big Beautiful Bill Act. So, Brett, welcome to the show, and you could let our listeners know a little of your background in terms of what you bring to the table here.
I'm a CPA with a master's in taxation. I also just finished the RICP program at the American College, so that was kind of fun. And I've always been a tax guy. I started out at big accounting firms. So I did Arthur Young, Arthur Anderson, Touche Ross. That was back when they were the big eight. I left public accounting after about 7 years and then fell into corporate tax departments for the next, 25 years or so. And, dealt with large publicly held Fortune 500 companies with, literally hundreds of subsidiaries worldwide. And, I did a tour of duty in international tax and basically ran a tax department, couple tax departments, established a tax department. I worked for a short time for a very privately held company, which, when you blew all the smoke away, was really a very sophisticated family office with a bunch of businesses bolted onto the bottom of it. So that was an interesting experience to deal, soup to nuts with business, personal, estate, trust, the whole 9 yards. That takes us up to about 2014. I've been semi-retired since then, and I work for generally smaller or regional CPA firms as a back office or back room specific tax consultant, focusing on, planning and complex returns. And I can do a tax return if it's an emergency, but it's really not the highest and best use of my skill set or my interest. So that's a quick summary. Sorry.
Great. Yeah, no, we recently had some episodes on the non-financial considerations of retirement, and I think we'd probably have a whole episode talking to you about that transition into wanting to be involved in continuing in the accounting world, but not necessarily on a full-time basis. But yeah, that background's really helpful because there's a lot to unpack with the legislation that was passed in July 2025, and it's the One Big Beautiful Bill Act is the formal name, or the OBBBA, 3 B's in there. So
whatever I try to politically agnostic, and I'm kind of in the middle of everything. I don't take sides, and it just is what it is.
Sure. Yeah. And so getting into that, there's a lot for us to unpack with the legislation. Before we really dive in, any just general deep thoughts on the whole process of tax planning and what really motivates you when thinking about these things?
Tax planning is always important, and it's important, from high net worth down to kind of high earner, high upper middle class. But there's even planning opportunities with folks that are on a constrained budget, and especially when there's a new tax law like this, you really have got to start that planning engine. As we'll talk about this bill a lot, there's a lot of what are typically called by Wade tax torpedoes, and there's traps where if you fall within that phase out, while you may be in a 32% bracket, your marginal tax rate during that phase out may be up to 54%. You know, the interaction of uh, uh, qualified business deduction and the SALT limitation is just a classic example. So it's really incumbent upon a lot of people to really, for these at least first couple years, do your tax planning. And
Mhm.
you know, the other thing that's really dangerous, I'm sorry, the other thing that's really dangerous is you can't do tax planning on the back of a napkin anymore. The rules are just too complex. We have a complex tax ecosystem, and you really need to do comprehensive planning, hopefully 2 or 3 years out into the future, to really get the full benefit of all that effort.
Okay, and so really then diving into things, the first item I think worth discussing are just the general federal income tax brackets, and maybe the only aspect of the legislation that simplifies things. I was happy I could, when I update the retirement planning guidebook, I could stop saying there's going to be a new set of tax rates in 2026. So there's some simplification with tax brackets, if you could mention that. But then really, I think my chapter on tax planning is ultimately going to be longer because of all these new phase outs of deductions that we're going to be talking about as well.
Yeah, it makes a tax rate map a very bumpy ride. So tax brackets stay the same. So we're start at 10% and we go to 37%. The old brackets were 10% to 39.6%. And the brackets would have jumped. So, for example, if you're in the 22% bracket, now you would have been in a 28% bracket. Excuse me. Or the 12% bracket would have been a 25% bracket. The other thing that's incredibly important is that our brackets are broad now. The brackets, if they had reverted back to pre-Tax Cuts and Jobs Act, were much, much narrower. So the other thing that's interesting is that we've gotten an extra couple of years of inflation adjustment into the 10 and 12% bracket. So what that's actually done is it squeezed the 22% bracket a little bit and expanded those two lower brackets. And that's something that everybody can take advantage of. It doesn't get phased out. It's wonderful. It's basically $700 for married filing joint. But hey, you know, you um, take your successes as singles, and if you hit enough of them, you've won the game.
Yeah, and as we get into this, a common theme is going to be when do all these things begin? So the specific point you mentioned there, the 10% and 12% brackets are going to get an extra inflation boost. That's something that will begin next year.
Yeah,
However, with standard deductions, there's some exciting news for this
yeah.
year.
Standard deductions are impacting us for 2025. Married filing joint is now 31,500. Another way to think of the standard deduction is that that's really your first 0% tax bracket. Because if I make less than 31,500 married filing joint, I got a standard deduction of that. My taxable income is zero. And just to think back a few years before we had the Tax Cuts and Jobs Act, married filing joint standard deduction was about 12,700, I believe. So it's a huge increase. The reality of that is it took a whole lot of people out of itemizing their deductions and just taking the standard deduction because it was bigger and convenient.
Mm-hmm. So 2025, the standard deduction increases $750 for singles, $1,500 for married filing jointly. Yeah, like you were saying, that's really a 0% bracket as you feel the standard deduction.
Mm-hmm.
And also, as you say, the standard deduction is larger than it was historically. to help avoid itemizing. But maybe the next thing to talk about, and this is where things get more complicated, there are a number of new below the line deductions that you can take even if you're not itemizing, which means you can take the standard deduction and also take some new below the line deductions. Probably the one getting the most media attention, if you could talk about the age 65 plus below the line deduction.
So the senior deduction is new. The politicians were talking about making Social Security be tax-free, and that's the way it used to be back before the early 1980s. Obviously, that was way too expensive to fulfill on, so they came up with this standard deduction regime. So if you're over 65, you get a add-on $6,000 deduction per person. So married filing joint, you have an additional $12,000 of deduction that is below the line. And just quickly, the significance of that is a lot of the phase outs are based on adjusted gross income, which is the subtotal before you get to your below the line deductions. And we'll talk more about that later. So if you're married filing joint, this starts to phase out at $150,000. Once you hit $250,000 of AGI, your senior deduction is gone. So if you're ideally situated at $150,000 of AGI, and let's say 90 of it is portfolio income, and your Social Security between both spouses is 60, then this is going to save you about $2,500 of taxes. If your 60,000 of Social Security was tax-free, that number is a little over 8,000. So it's a partial solution. You don't have to be claiming Social Security to get it. You just have to be over 65 with adjusted gross income of less than 250,000 if you're married filing joint, and those are the basic requirements. The singles thresholds are lower than that, obviously.
Yeah, and to clarify, that's like a second age 65 plus below the line deduction, because we do also have the
you're still
2,000.
You're still going to get your add-on to your standard deduction. So it's really a sweet deal, but it's ideal for those people that have about 150,000 of adjusted gross income on an annual basis. So if you have a super large Roth account and modest taxable accounts, then you might be right in a sweet spot, but individual facts will vary.
Mm-hmm. So if you're married filing jointly and you have two people age 65 and older, you've got your standard deduction of 31,500. Mm-hmm. You have an additional 3,200 for that standard deduction. And then you have another, because there's two 65 and older, $12,000 for this new below the line deduction that phases out. So if you're under the $150,000 AGI, you're looking at below the line deductions now of $46,700.
Yeah. So it's a real help to retired folks that let's assume they don't have a massive Roth, and so if they're trying to maximize their retirement income with a constrained portfolio resources, this is going to be a great help.
Brett, did I catch that correctly? While Wade was recounting the list of the deduction limits and things like that, did you double fist pump? Did you do a double fist pump in excitement?
Oh, yeah.
As in hell yeah kind of thing?
Yeah, and if I can kind of segue.
You really did, right, Wade? Like
Yeah, it's
he was
exciting.
like born to be a CPA.
Yeah,
I was
He
born
didn't
to
choose
be
accounting. Accounting chose him.
I spent, oh dear, yeah, I spent 2 painful years as a computer salesman when I got fed up with auditing before I really became a tax specialist. And
I think
yeah,
that
no,
coincided when I bought stock on Commodore 64. Thank you.
oh yeah, there you go. Yeah. Uh, yeah, I should be in the back room, doing the technical stuff. I'm not a salesman.
No, but for our listeners, he had a genuine look of excitement, and he was literally double fist pumping when Wade was recounting the new deduction limit levels.
Well, Wade's chapter in his guidebook on taxes, absolutely, without a doubt, the best stuff I've ever read
Oh,
on
thanks.
taxation in a financial planning book. Right? I mean, really comprehensive and
No, it's
logical approach.
I read it, but only on Thursday nights after midnight.
Well, thank you, Brett. And I guess it would behoove us to maybe lessen the fist bump a bit, just because this particular deduction we just discussed, it's available this year, but it's 2025 to 2028, and
Yeah,
then it goes
yeah.
away.
And that's the other reason we
So,
need to plan is this bill is very broken up in terms of different start dates, different stop dates for different provisions. And it's, don't get me started on tax policy, but it's really kind of sad to see because they're gerrymandering all this stuff to fit within a budget window, which, yeah, the joint committee is going to come up with a projection, and it's the best they can do in the heat of the moment. But whether their projection is going to hit reality or not is completely unknown. And we're all subject to the forces of macroeconomics, and that changes everything in the future.
yeah. Yeah, and so actually, if you're trying to keep organized here, we're talking about below the line deductions available even if you're not itemizing. So even you can take the standard deduction, and there's 6 of them we're going to talk about. So it's like this is going to go on for a while. Probably the age 65 plus one is getting the most media attention, but number 2 out of 6, qualified business income. I think this one's a lot more complicated, but if you could comment a little bit about.
This is a lot more complicated. It may not apply to your classic retired person, but for somebody like me who still has a, relatively modest Schedule C going, it's qualified business income. Excuse me, will allow you a deduction of basically 20% of that qualified business income. There's a lot of little nuances in that rule. If you basically can go up to about close to $400,000 before all the cutoffs and limitations hit you. There's really 2 classes of people once you get up to that, let's say $400,000 level, and that's specified service, trade, and business people. So that's folks like me and you and attorneys and doctors and business consultants. So if we have more income than that, our QBI deduction goes away. If I'm a restaurant operator or a machine shop owner, then it doesn't go away, but it is throttled back to the lower of a couple of standards. One half of my W-2 income, or I can pick 25% of my W-2 income and then 10%. Anyway, some small percentage of my total capital assets in my business at historical cost. And so if I'm running a machine shop, I'm putting a lot of people to work, and I'm going to get my full QBI deduction because I've met that test. But if I'm a doctor and I make $500,000 a year, I don't get a qualified business income deduction below the line. And so that came in 2017, and it was a response to the small business people who had flow through type income, and to equalize them with the reduction of the corporate tax rate from 35% to 21%.
Okay. And of the 6 we're talking about now, this is the only one that existed before the legislation, but it's now made permanent as part of the tax code. So you can enjoy your QBI forever.
Yeah. As long as you want to continue to, participate in the labor market or participate in the business market and run a business. And
Right.
by the way, you're paying employment taxes on all that, which is, when I first started working, that was no big deal, right? I mean, I blew through my limits, by the end of the first quarter, and it was behind you, and you pay, a couple $1,000 in payroll taxes, and you're done, right? But now, if you're self-employed, payroll taxes are 15.3%, and they last forever. The Medicare part of it lasts forever. And then if you have net investment income tax on top of your self-employment tax, it becomes demotivational.
Fair enough. Yeah.
Sorry.
It adds up because that's separate from income
you're right.
taxes.
Yeah. And only
Now the
half
next one.
deductible.
In fact, this podcast is going to be 3 hours. It doesn't do us any good to make it past 90 minutes, Wade.
Yeah, we're gonna run out of deductions. But the next one is part of the campaigning and so forth. The tips, qualified tips. Now,
So
it may not be as sweet as it sounds without getting into the details, but what are the details about deducting tip income?
the tips max deductions 25,000, which is not bad, not bad. The phase out starts at 150,000 single, 300,000 married filing joint, and there's some nuances to it. You have to be in a profession that the IRS recognizes as being a standard tip position. So a bartender's an easy one, right? But if you're an attorney and your client tips you, I'm sorry, that doesn't qualify because you don't have a tip position. Excuse me just a second. And then the definition of tips also has to be a voluntary, consensual, non-mandatory payment. So now if you go to a big restaurant and you have a party of 8 and there's a mandatory 20% tip added to the bill, then that tip is not a qualified tip because there's no discretion on the part of the patron. And so you're gonna see that get played around with, and they'll come up with 20% tip suggested.
A phraseology on the.
You can avoid that by washing dishes for half an hour in back by the dishwasher, but they'll try to come up with something to make that qualify. So the other thing that happens is
Wade and I just cannot avoid endless soup and salad. We're suckers.
Yeah.
And we look for friends.
So again, all that tip income is going to be subject to employment taxes. It needs to be for post 2025. If it isn't on your W-2 or your 1099, then you don't get it. For 25, the W-2 is already out. They're going to allow a couple of different approaches to determining what your qualified tip income is, and that's the basic gist of it.
Yeah, and you made the important point that everyone can't just run out and ask their employers to tip them instead of paying them a salary. It's not that straightforward.
Right. Yeah,
Not
it's
gonna.
controlled to that list, which is out in tentative form uh, uh, for traditional tip positions.
I will say this
So,
though, Wade and Brett. That would be a great like Seinfeld type of episode. I know once, remember there was an episode where George like put out the $20 that was available in tip and started deducting based on like if the water took too long to refill. But could you imagine an episode where literally like you're paid on tips with your coworkers? Thank you.
yeah,
Thank
well,
you.
there's tax pooling and all that stuff, right? Yeah,
Wait,
that's
would I be able
Uh,
to make rent?
if you had to rely on tips
Yes.
from our listeners,
No, well,
I don't
forget
know.
that. I mean, from our workers. I think I'd have to pay money to our listeners. It's the other way around.
Alex needs to set up a tip jar on the podcast site.
There we go. Patreon.
well. My current wife and I met at the old spaghetti factory, and I was a bartender and she was a waitress. So
There we go.
that was a long, long time ago. I don't think I can move fast enough to be a bartender anymore.
Yeah, and then this one does also. Well, all of these we're talking about phase out. I think all but one of the 6 are going to phase out with income. And what happens is if you're getting tips that are qualified and deductible, the phase out is going to hit you generally in the 22 and 24% brackets, which raise your effective marginal rate to 24.64% or 26.88%.
Yeah.
So
Yeah.
it might like if we're thinking about like with the tax planning, if we're thinking about Roth conversions, that might not put you over the hurdle of stopping a Roth conversion. But some of the things we're going to talk about for later on when we get to state and local taxes, that's going to be a real roadblock on.
And with all these bumps on the tax roadmap, the tax rate roadmap, man, doing a Roth conversion based off of back of the envelope calculation, just assuming that, you're going to be in the bracket that your income is in or you think it's going to be in, it'd just be tremendously dangerous.
And you couple that with the state that Wade was alluding to earlier.
Right. And I live in
California, here we come, right?
So, no capital
Brett's in
gain.
California. I'm in Texas, so I don't worry about state income.
We're rub it in.
Rub it in. Next one, it's a cousin of the tips, qualified tips. It's qualified overtime pay. This is a new below the line, non-itemized deduction. We could talk a little bit about that one.
Fortunately, before the shutdown happened, we did have draft forms for these items come out. Now that the federal government's shut down, my hope is they're still working, but I'm not sure there's going to be issuing a lot more draft forms out to the tax community for us to chew on. But so overtime is it's I hate to be negative, but it's a little more limited than you might think. So first you have to be an employee in the right classification, which basically means hourly non-exempt. And so if you're, an assistant manager at a CVS or something, yeah, you're working 70 hours a week, but you're not getting any overtime. And you don't qualify for this because you're an exempt employee. It's a $12,500 deduction. 12,500 is the max. And again, it's sort of the same phase outs, 150 and 300, I think. I know 300 for married filing joint. And again, the deduction that you get is only the half of your time and a half hourly wage rate. So you're still going to pay full tax on your regular time. This qualifies you, only your half in time and a half qualifies for the deduction. Again, it's similar in that this deduction, that half is subject to full payroll taxes. And, What else have I missed? I think that's basically the outline of the deduction. So again, it's great if you're a non-exempt hourly employee who works overtime. Another help on your income tax liability.
Yeah, and then so with the tips, it was up to 25,000 for singles or married filing jointly. With the overtime, it's the 12,500 for singles, but 25,000 for
Right.
married filing jointly.
12,500 per worker. So if you're married and you're both non-exempt hourly workers, you have a shot at $25,000.
Mm-hmm.
Absolutely.
And they're 2025 until 2028. Also, they're part of that family of temporary things we have now for the next few years.
So this is again just extremely frustrating, but we'll see what happens. The primary reason for the shutdown is all the health related stuff and who gets thrown off and how much credit you may have to recapture and all the rest of it. So, we could have another bill, and some of this other stuff may fall in underneath it, but something has to happen between now and 2028 or it just goes away.
Yeah, and then the third one in this family, the tips, the qualified, or the overtime pay, and then the third one is the auto loan interest.
Yeah,
and talk a little bit about that.
Is it's great if it works for you. Okay, you need to purchase a new car in 2025 or later. It needs to be assembled in the U.S. You need to provide the VIN for it. This is for personal use only, generally, right? And you could decode your VIN code, and if it's the first character is a 1, 4, or a 5, it's generally U.S. assembled. The max interest deduction is $10,000, but the phase out starts at $200,000 for married filing joint. I believe it's $100,000 for single, and for married filing joint, once you hit $250,000, you don't get any deduction at all. So, and so I'm in a, I went out and bought a new 2025 car, and I bought it on November, 20th of 2024. And so I thought, oh man, I'm going to be able to deduct my interest, right? Too bad, so sad, you lose. I don't care if you bought your new car assembled in the U.S. on the 31st of 2024, December. You don't get it. You don't get it. So a lot of little hoops to jump through. But if you did buy a new car and you did finance it, it's worth looking into.
Yeah, and like you were saying, so that one phases out over a $50,000 range, so that it's a 20%. Like each dollar of income, you lose 20 cents of your deduction here. So it multiplies tax rates by 1.2 in that when you're making the tax map.
Yeah.
None of that stuff had to be in the old edition of the retirement planning guide because it's more complicated now.
Well, you're extremely good at the math, Wade.
Well, thank you. The sixth, so out of the six here, the sixth one is the only one that doesn't phase out. So that does make it a little easier. But the newest member of the family of non-itemized deductions would be, and this is only available if you take a standard deduction, a new charitable contribution separate from itemized.
Right.
Well, and only available if you're using the standard deduction.
It's available if you take a standard deduction. It's $1,000 for single, $2,000 married filing joint, $1,000 a piece, and it's important for the seniors. You have to do a cash contribution to a public charity, right? So I can't, rent a pickup and haul a bunch of stuff off to Goodwill that's worth a couple $1,000 and take a deduction. It's a cash deduction. And
No donor advised funds either.
But no donor advised funds. That's always a tricky point. And but if you're not itemizing, you need to remind all your seniors, especially, that keep track of your deductions and claim it here.
And then that also does not begin until 2026, so you can't use it this year.
Or this year, right?
But starting next year, that one is permanent though. Starting next year, so you have that opportunity. You can get your standard deduction and up to 1,000 for singles, 2,000 married filing jointly, cash donations. You can also deduct, and it doesn't phase out, so that's nice.
Yeah,
I'm going to definitely take advantage of that one
until they change it, right? So, nothing's permanent in the tax law, but you're absolutely right in the characterization. It is a non-moving code section.
Right. Permanent until new law makes it non-permanent. At least it doesn't. It's not legislated to end at any point in the future. So that's probably an episode in and of itself. We'll keep the recording going because we're just getting to the beginning.